giving us another look into the health of the consumer, starting with Lowe's. We are watching those shares gain almost 3% after reporting a smaller than expected drop in comparable sales in its second quarter. Those sales on that basis up down 1.6%. Analysts were expecting a 2.6% drop, saying it saw a strong spring recovery and online sales growth. The home improvement retailer also beat estimates for adjusted earnings per share and just missed on overall sales. And we also got second quarter results from Macy's, the department store, reporting better than expected sales and merchandise inventories down 10% compared to the year prior, helped by spring clearance sales. The retailer beat estimates on its top and bottom line. The shares, though, are down a lot this morning. And Macy's, while those numbers make it look pretty good, I think by most measures, Macy's was not great, right? If you look at the various numbers here, and particularly if you look at the forecast from the company, it says its third quarter adjusted loss per share is going to be 3 cents to a range of a loss of 3 cents to a gain of 2 cents. Yeah. Analysts have been looking for earnings per share of 27 cents.
Yeah, and if you're looking through to see what they're saying about the consumer right now, this played through in their guidance that you were mentioning a moment ago. In light of ongoing macroeconomic pressures and uncertainty on when those will abate, the company continues to take a cautious approach on the consumer, even though it did reaffirm its annual sales and earnings outlook here.
Yeah, and if you look even in the quarter, even though, again, top and bottom line beat, if you look at the individual comparable sales numbers, they're not great, right? Yeah. Macy's comparable sales were down 9.2% on an owned basis, 8.2% on an owned plus license basis. Bloomingdale's comps down 2.7%. Blue Mercury was the bright spot here, up 5.8%. But Blue Mercury is just a small part of the overall numbers. And something else that stood out to me was what was going on in its so-called other revenue, which fell by $84 million to $150 million. So again, a small sliver of its business. That's the credit card business. That's its store-owned cars. And there it called out delinquencies. And what Macy's says in its commentary is, we knew there was going to be an uptick in credit card delinquencies because of the macro environment, but it is happening much more quickly than we expected. Right. Why does that stand out to me? Well, obviously that doesn't just have to do with Macy's necessarily. We should be paying attention to credit card delinquencies more broadly when you hear a call out like that.
No, it's spot on. And one other thing that caught my attention here is just the type of way that they are selling into customers here. I mean, when you hear about the STAR program rewards members making up approximately 72% of Macy's brand comp owned plus license sale on a trailing 12-month basis, that's only up approximately 3 percentage points versus that prior period. And think about the different channels that Macy's has to really make sure that they're continuing to drive more of those engagements. And if you break it out in two segments, it is in the brick and mortar division, and then on that digital side, brick and mortar sales, they were down 8%. Digital sales, they decreased 10% versus the second quarter of 2022. So what's going to change? They're going to change the capacity of how much square footage they might be operating. And that's something that also came out in tandem with this release. They're opening up even more of kind of like these mini Macy's approaches, where I think they've got a much more flashy name that they've put on it. But the square footage particularly, that's where you're going to be looking for them to provide what they're calling convenience and discovery within a 30,000 to 50,000 square feet box here, located in some off-mall shopping centers, different than the historical purchase.
Right, and there's been some reporting recently that those strip malls are actually doing better in this environment than the indoor malls. To get over to Lowe's for a minute as well, this was an interesting report because, again, comps were not as bad as estimated, and the company called out its pro business, that is, professional contractors. That was a surprise to the analysts over at Jefferies, who, out with a flash note in the wake of these earnings, says that the press release from Lowe's is scarce with details, though a notable surprise is pro sales up versus the slight decline posted by Home Depot last week. We're always looking at these versus each other.
Sure.
So that's an interesting point of differentiation here, and an area where Lowe's did a little bit better this quarter.
Yeah, battle of the aprons, the blue apron at Lowe's versus the orange one over at Home Depot. But again, you think about what the management team is doing here, and I think they positioned it quite well in how they were speaking with investors, talking about making sure that they are not only improving that customer experience, but also trying to cut and reduce expenses here. CEO Marvin Ellison, CEO and President and Chairman Marvin Ellison, saying that they're reducing expenses while improving customer service, and that really being the result of execution by their team. And for that effort, they are awarding over $100 million in discretionary and profit-sharing bonuses to them this quarter, too.
Yeah, I mean, to be sure, it's not like Lowe's is killing it here.
Yeah.
I mean, they're still seeing declines, but I think execution is probably the key word in what you were just saying. And again, to go back to that Jeffries note, the analysts there are saying nice margin management as DIY remains soft in the current backdrop. So it's just a matter of managing through what is looks like a pretty challenging period.
Yeah, and really strong inventory execution there. They talked about that and that improving as well. No doubt a major theme over the course of this retail earnings season that we've been watching here. Also, as we've been talking about earnings from Lowe's this morning, coming in a little more optimistic than its competitor Home Depot's results last week. Lowe's comparable sales down a little less than expected at 1.6%. Meanwhile, Home Depot's were down 2%.